We'll start with Delaware's and Delaware Statutory Trust, just an overall description. It's an investment vehicle, sometimes gets taken as a tax strategy, but it's really an investment vehicle that enables a real estate seller to maintain an investment position in real estate without the personal management responsibilities. And like Greg said, he'll go into a couple more details, but high level limitations are this is only for real estate, right? You can't use this for the sale of a business. As an example, you have no control over the investments, no control really over distributions. And the key thing here is, one of the key things that folks compare is the liquidity. And on the Delaware Statutory Trust side, they're typically liquid for 7 to 10 years. And so Greg kind of take it from there, but really what it comes down to is the difference in flexibility, the difference in control, and the difference in liquidity.
All right. Well, thanks, Paul. So just digging deep, what is this animal? And Paul said it perfectly. It's actually an investment vehicle. So one of the interesting things about, the acronym is a lot of people hear the acronym DST and they, because maybe it's more well known to certain folks, they automatically think of the Delaware Statutory Trust. As we go down the list here, you're going to see that the Deferred Sales Trust has the same acronym of DST. So unfortunate coincidence of the acronym, but they're different. They're different animals or different vehicles. So Delaware Statutory Trusts were created with a specific goal in mind. So most of you have probably heard about REITs, real estate investment trusts, which are, syndicated ownership in real property where individual investors can invest and own a piece of a REIT or a real estate investment trust, which is managed by, a sponsor, put together by a sponsor or developer or syndicator, whatever you want to call them. But in the area of REITs, the ownership is characterized as personal property. It's almost the same as owning a stock or a bond or a mutual fund share is the character of ownership in a REIT. So because it's personal property, it was not eligible, or they still are not eligible, for people that want to think about doing a 1031 exchange, selling an investment property, and then moving it into a passive real estate opportunity. If you don't want to be a landlord or have the management headaches anymore, or maybe you can't find a suitable upside property and you're in a 1031 exchange, then, there was no place else to go. You would fail if you couldn't find property. So one of the reasons Delaware Statutory Trusts were created was that they could create what amounts to a REIT, same exact kind of animal in many respects, but by law, they characterized your individual ownership as fee simple ownership in real estate. Now, voila, it qualifies, and the IRS has ruled on this. They've agreed that it does qualify as a successful real estate upside purchase out of a 1031 exchange. Now, people can invest in Delaware Statutory Trusts as a 1031 exchange move, or not. It could just be I have other money I want to invest, and I want to put something into a passive real estate opportunity. You could do that in a Delaware Statutory Trust. And so, one of the things about Delaware's is that there are sponsors that have different classes of real estate. So you may be interested in an industrial space. You may be interested in commercial office. You may be interested in multifamily. So there's products out there in each of these classes of real estate, and the syndicator, often known as the sponsor, is the one who organizes, acquires the property, obtains the financing for the property, and so the financing gets assigned to you in the percentage that the Delaware is offering. Now, some Delawares will have a very specific amount of financing. Could be low 30%. Some could be 50%, 60%, could go all the way up to 80, 82% financing. So that's what's attractive to 1031 exchangers, because the amount of debt you have to replace when you do an exchange is very specific. And so these are kind of custom made to be able to deal with that if that's what you want to do. So, if everybody understands it's a passive ownership in real estate, you have to be an accredited investor in order to participate in a Delaware Statutory Trust, which means that you either typically you have to have at least $1 million in relatively liquid assets, not including the value of your home, or you have to demonstrate that you've earned $250,000 a year for each of the last 2 years. Maybe a little bit higher if you're married. So, and if you don't qualify at that level, then you're not really permitted to invest in these things. That's one of the rules and regs about this. But it's it's fairly simple to engage in these types of things. You just find the product. Most Delawares are available through the financial advisory community. So, and not every financial advisor deals in alternatives in this space, but many do. And that's often where you get your due diligence and information about the types of Delawares that might be available. Sometimes realtors know about these, and obviously 1031 exchange accommodators have some familiarity with these, because often some of their clients are using that as their replacement vehicle. So, as Paul said, these are illiquid assets. It can enable you to defer the taxes if you're selling real estate and real estate only. Can't sell a business and then go into a Delaware. Can't sell collectibles and go into a Delaware. You can only sell real estate and go into a Delaware. So it's going to be fairly illiquid for usually about 7 to 10 years. They're going to provide you with a estimate of what your annualized distributions might look like. The lower the loan to value on the property, the higher the distributions can be. The higher the loan to value that you have inside of this property, the lower the distributions would be. Historically, Delawares have often returned, 5 to 8%, average annual return. There are a lot of fees associated with Delawares, which is probably one of the reasons why we're not usually seeing double-digit overall returns in these spaces. But also keep in mind that, a Delaware is an investment in a single asset class and often a single asset. Now, it could be a 1,000-unit apartment building, or it could be a 25-story, office tower. It could be an Amazon distribution center warehouse, which is 10 football fields large or something like that, right? So, just keep in mind that if you're investing your assets, never really think about putting all your eggs in one basket. So real estate's a good space, and it may fit within your portfolio, but just understand that once you go in and you have an understanding of the distributions from the rent, et cetera, that they're going to be receiving and then paying you on either a monthly or quarterly basis, typically, you really have no control beyond that. So the sponsors will have all the control. They'll decide when to sell. They'll give you, hopefully adequate notice when they do, so you can think about what's next. But that's something that, is available, and that's the Delaware Statutory Trust. So unless you can think of anything else, Paul, why don't you move on to the next one?
I think one thing we get asked frequently, and it's a good thing to have for everyone here and everyone who watches this later, but one thing we get asked is, well, what about a Delaware for a portion? Have you guys ever used the Delaware Statutory Trust in conjunction with the Deferred Sales Trust in a unique case? The answer to that is yes. So a few sales that have happened this year where they were selling real estate. One of our clients closed in Temecula. Another one is closing up in Pasadena area. In their situation, they have what we call mortgage over basis. So the debt on the property is greater than the basis of the property. So purchase price plus capital improvements. What we do with the difference, either the client has the ability to pay that, write that check to the IRS, or we can put that amount into a Delaware. So the point being, we use Delawares when, as needed, as Greg mentioned, in situations. So we love everything tax deferral. The purpose, of course, of today is to go through all the options, but specifically about Delawares, we will use Delawares in situations where it's appropriate for a portion of their overall umbrella, which is all really under the DST. So the Deferred Sales Trust. So that's great. Very, that's the Delaware.